Hey there, Eric from 5minuteinvesting.com. So today, our case study is going to be about Netflix, which is one of the stocks that our members subscribed and picked. So I'm very excited to do this analysis this week because Netflix is obviously a great stock, great business model, subscription-based service, and they have a lot of partnership. So if you live in North America, you probably heard about Netflix or you do have a Netflix account. And basically, there's a bunch of TV shows on it, a bunch of movies on it. And recently, they have been doing their own partnership with different studios to create their own series. This includes English series as well as Korean series and other language series as well. So they're expanding into the content creation space. So great company, great business model, very stable in terms of revenue. So the key revenue driver here would be subscribers and how well they can keep their subscribers. And so far, everyone who uses Netflix are happy from my knowledge. I personally don't have a Netflix account and I don't have any Netflix stock. So let's get started. So when we look at Netflix, let me move myself down right around here. You'll see that this is a weekly chart and the trend is up. Now over the last 2-3 years, let me hide the ad here. If we exclude the Bollinger Band, you'll see that it's a very nice uptrend. It went from $30 all the way to $188. Great trend. Monthly, same. Basically, Netflix skyrocketed since 2013. And then if you buy this at any time, generally, it's up. So let's add in the Bollinger Band. So once we add in the Bollinger Band, you'll see that good buying opportunities generally happen when it touches the lower part of the Bollinger Band, like here, 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 where you can buy at a more favorable price. And if you look at the 100 EMA, the red line, these also presents good buying opportunity. So right off the bat, without looking at anything else, I would wait for either the price to touch the lower parts of the Bollinger Band or the 100 EMA. So you know that historically, Netflix has not hit the 200 EMA, which is very important. And this is a very good indicator that Netflix is a strong stock. So that means what I'm aiming for really here is around an entry price of 165 to 140, preferably closer to the 140, 150 side. Now, you'll notice that there's a psychological barrier here. So if Netflix touches 150, chances are people want to buy it for sure. So then 150 would be what I'm aiming for. So looking at support and resistance, let's move it over here. It's a bad spot. Looking at support and resistance, you know that there is support right here. That's the first one, the easiest to see. And then we'll look at the second one. Now again, when you're looking for support and resistance, the most important support and resistance would be the most recent one. So the 200 one, which is the most recent high, and the most recent low, which is around 165. And all the other ones are not as significant and not as significant. So, okay, save that. So this gives you 3 potential areas to buy. Now, right now we haven't done our analysis on news. We haven't done our analysis on fundamentals, valuations, and so on, and insider activity. So right off the bat, you would think, okay, there are 3 possible areas which Netflix can bounce on, which is the 150, 165, and 130, assuming it is not a change in trend. Chances are, looking at the historical pattern, you'll know that it wouldn't really dip below 100 EMA. But of course, right now the market is at a really high point, like general S&P 500. So I would aim to enter somewhere between 148 and 165, preferably closer to 150. Okay, all right. So jumping back to the business model. So in the future, TV is going to be eventually phased out, in my opinion. And it will be based on subscription model like Netflix, or people would just buy it on Amazon or Apple or Netflix. So these are the big players of the entertainment industry of tomorrow. So obviously, they really emphasize on innovation. So, okay, let's look at why it is dropping then, because we're curious to know why. It might be because, oh, it just reached a top, but we preferably want to figure out why they're dropping. So let's see if there is a reason. So I'm just scanning through news to see if there's anything weird that would signal Netflix is not a good buy. So right now I'm at December 1st. So the drop happened approximately in November. So there isn't really a reason. I'm still in December, eh? So I guess YouTube and Netflix are, of course, competitors. But there isn't anything specifically that explains this drop. Now, this is important because every time the stock drops, you want to know why. And it has been in such a long uptrend position that it makes you wonder if a correction is due. Like if something like this back in 2016 December is due. So if something like this is due, then you want to wait for a better buying opportunity before actually entering on Netflix. So okay, if we can't find anything from the news side, let's look at the financials. So again, I'm on Morningstar. This is a free service, and we can start with revenue. Obviously, revenue for the last 5 years, growing 3 million to 8 million. So if you didn't watch the video about what kind of company and what you should look at when you're doing fundamental analysis, I explained there are two types of company, bankrupt and growing. So Netflix is obviously a growing company, nowhere close to bankruptcy. So then, yeah, you look at the income statement. So again, very consistent increase in sales because they're subscription based. So the more subscribers they have, the more revenue they have. There's really little manipulation in accounting, from my opinion. The worst thing they can do is to recognize the annual subscription if they have any. So R&D, you notice that the R&D is increasing. So this might give us a hint that they expense all their R&D onto their income statement. So again, operating income not really increasing as quickly. Even you see that revenue went from 5 to 8 million, the operating income didn't really increase. So that's one thing to pay attention to. Similarly, revenue increased from 5 billion to 8 billion, but income before taxes did not increase as well. So, okay, let's look at earnings per share. So let's say Netflix is going to continue to make the same amount of profits for the next 10 years, which is at 44 cents. So if each year it makes 44 cents, for the next 10 years it's going to make $4, and for the next 20 years it's going to make $8. So compared to what Netflix is today, it's $186. So that means divided by 0.5, let's round it up. That's 372 years, assuming no growth, assuming no change in subscribers, they make the same amount of money as they do today. And you know that they don't spend that much on research and development. I mean, if you take out all the research and development costs and your net income would be boosted up to $1 billion, but right now they're investing more in research and development. So if I need to recap the income statement, 5 years growing in revenue, great. Net income, not really growing. That's not so great. Earnings per share, obviously not that high because it's a tech company. They invest in R&D, so it makes sense that it's not as profitable as like manufacturing or shipping companies. So let's look at quarterly. So now obviously there isn't December results yet, so there's no Q4 results, and we can only look up till September 2017. So right now you'll see that revenue for the last 5 quarters, it's growing. Yeah, and gross profit growing as well. Net income growing. So this is obviously a good trend, but you'll see that there was a dip in the second quarter this year. And then now it's starting to bounce back. I see. So they have debt. And net income, obviously there was a dip in Q2 as well. So if I go to Q2, let's see what the price is doing. So you'll see a small dip here, and afterwards it actually went up. So I bet they released the Q2 earnings here, and there was a dip, and then people keep buying it, and it keeps going up again. So just by looking at the income statement, you'll know that the net income is really low, and chances are before I even hit the valuations tab, you'll know that we're going to be looking at price to sale as our main measure, or price to book, because if they expense all their R&D, chances are it'll just be price to sales would be the most accurate measure. Well, the good news is that they have a lot of cash. So as of 2016 December, they have like $1 billion in cash. So that is not a problem at all. They don't have a lot of property, plant, and equipment, obviously because they're just a software company. Long-term assets, I bet this is mostly intangibles related to the rights of the TV shows they have or the movies they've made and so on. This might be okay if we can explain it by saying, oh, they have been doing a lot of partnerships and they have been creating a lot of content, and hence they recognize it onto their other long-term assets and then amortize it over a period of time. But of course, the dramatic increase from 1.5 billion to 7.6 billion makes you wonder if a portion of this should be expensed. And again, you look at liabilities, and you look at equity. So total liabilities and equity is 13 million, and you have approximately 11 million in debt. So that means your debt to equity ratio is 5.5 times. And that is actually relatively high and higher than I would like it to be. I mean, one way to justify such a high leverage is that Netflix is relatively stable, because when you look at the revenue stream, it's like rent. You collect rent monthly from your subscribers to watch those content. It's like when you buy a house, you get a mortgage, and the only reason you can get a large mortgage is because the only reason you can get a large mortgage is because you know that you can rent it out. So if you put 20% down and a bank gives you 80%, that's going to be 80 divided by 20%. That's going to be debt to equity of 4 times. And right now, Netflix is 5.5 times debt to equity. So if I went too fast there, what I was trying to do is to see how leveraged Netflix is. So when you look at investments, you have GICs, you have bonds, and you have just buying a pure stock where you're not leveraged at all. You use all your own money and you don't borrow any money from anybody. And on the other side, you have like buying a house, and you would put 20% down, which is not a lot. I'll put 10% down, and you get as much money as you can from the bank. So then you don't have to put a lot of money down to buy a house. So if Netflix is thinking like, okay, we are very similar to real estate because our revenue is very predictable, then chances are they can justify to get a lot of debt because their revenue is predictable, and hence you can afford to pay the interest and you're going to be okay. But usually when you encounter tech companies like Amazon or Apple or Google and so on, they will have low debt because if you're a public company, like you're on a stock market, you can just issue more shares to raise more money, so you don't necessarily have to go to debt. Now, this may be because they're taking advantage of the low interest rate right now, but as you know, the interest rate is increasing. In this year, it has already increased 2 times in Canada. So in the future, I expect US to increase as well if US has not already increased. So this makes me wonder what kind of loan Netflix has. Let's see if, okay. Why is it in Excel? That's kind of weird. So usually I don't take a look at the financial statements if I'm doing a quick analysis, but in this case, because of how leveraged Netflix is, I do want to see their notes, which I'm not getting. Just give me a second here while I find it for you. Okay, so this is the, this is the December one, last year. So when you see that it is filed January 27th of 2017, that means this year, in approximately 60 days, you will get the 2017 version. So that's important, but chances are the loan, the note is not going to change. Let me just find the note to see if there's a quick link to get me there. If not, I'll just have to scroll through this. Blah, blah, blah. Consolidated balance sheet. Wow, they're reporting a lot of years. Debt. Long-term debt. Interest expense. Whoops, am I lagging? So right now I'm trying to find what the interest rate is, because this becomes important if it is a variable rate. Fixed rate. So, okay, now I kind of found the paragraph I was looking for. So let's go back one step. So as of right now, they have long-term debt of around 3.4, and then they have other debt of 3 mil, and then other currents of 4 mil. So there's actually a large portion of debts that are current, or current liabilities anyways. So out of the 3.4, they have fixed rate in 5 branches. Note 4. Of course, you can't just find note 4 by typing note 4. Okay, there we go. So this is the interest rate for the 3 point something million in debt. At the option of the holder. So that means if the holders want it back, they can call it. I see. So the debt itself is fixed, which is good. It just makes me wonder. Why is it so high? So this is a 3.4 we see on Morningstar. The non-current content liability, okay, 2.8. And then you have another 3.6 of current content liability. So when you're looking at the liability side of it, it's right here. So they grouped it, like Morningstar grouped it as other current liabilities. So let's figure out what this is. So they have 6.5 billion of total content liability. You know what I think it is? I think when you're streaming something, you'll also have, yeah. So the way it works in the entertainment industry is, let's say when you're streaming a song and so on, then you need to pay royalties to the artist and to the right holder. Like let's say I'm playing a song of Taylor Swift or Justin Bieber, then I need to pay them. So I guess same thing for movies. When you're streaming a movie, you need to pay a percentage of your revenue back to like Sony or Warner Bros. As you play their movie. So that's what this is. Let's take a look here. So then in total they have around 7 billion of content liabilities, which means they streamed and as they streamed movies and so on, which is part of their business. So basically what this is saying is that once it meets the criteria to be recognized on a balance sheet, then they would recognize the liability on a balance sheet. For example, let's say once the movie is streamed, or once they enter into some agreement, maybe like when they start streaming, they will have to pay out a certain amount on a regular basis and so on. Yeah, so for example, let's say I have 5 seasons, or let's say I'm trying to stream Lost. I don't know how many seasons I need to stream Lost for, so then they wouldn't record it, which is fine. Okay, so they're actually not as levered as I thought. So normally, when I calculate debt to equity ratio, I would just take the total liabilities divided by like the total amount of equities, and then I would just call it a day. Maybe, ideally I would look for 1.1 to 1. So for every dollar of equity you have every dollar of debt. Because if the debt is too high, chances are you wouldn't be able to pay interest on it, and that would bankrupt your company. Now, but when you're looking at Netflix, the amount of debt they have mainly owes to like Disney or Warner Bros. for streaming services. So then this becomes a question of cash flow, because chances are Netflix doesn't have to pay interest on 2.9 plus the 4.3. So then that means that's around 7, like I calculated earlier. So then that means out of the 10 billion here, only 3 billion is actually true debt, like real debt, because you're just basically you're just going to pay out money, but then you haven't paid it out yet. But then the amount of money you need to pay interest on is actually just 3 billion, which kind of matches with the shareholder equity of 2.6. If we round it up, it's around 3 billion as well. So the debt to equity again would be around 1.1 or slightly higher than 1, but I wouldn't be too concerned about it. So the question is, do they have a positive operating cash flow, which is the most important part? Because of course, looking at the cash flow statements, it seems like they don't. Oh man. So what I was expecting before I click on this statement was that this number is positive. And it's important because cash flow from operations show if you're paying more than you should, or if your business is bringing in positive cash. Because now I'm switched to quarterly, but then previously I was annually, because I want to see if on a quarterly basis if they actually has positive cash flow. So in this case, you'll see that okay, net cash provided by operating activities is negative across the last 5 quarters. Net cash used for investing activities is positive and negative, and then you have net cash provided by financing activity, even though it's kind of covered, and you'll know that they probably got some financing here and here to fund the losses in cash. I don't like the look of this. Yeah, from the financial statement side, it's not that great. You don't have a large retained earnings or equity, which I would expect Netflix to have. And Netflix does not have a positive operating cash flow, which I expect Netflix to have. And Netflix has a lot of debt owing to publishers like Warner's and Sony and Marvel and so on. Okay. All right, let's look at valuations then. So from a financials point of view, I would think this is not a pass. Okay, valuations. So again, it's a tech company, so you'll know that the price to earnings for a tech company is like way off the chart because they're not really making money and they're expensing R&D. So it makes sense that Netflix has an insane price to earnings. So this is what we're not going to look at. Now, in the event that we do have an economical downturn or like some sort of temporary recession, yeah, it would hit Netflix pretty hard because I think people would cancel Netflix. Second, again, price to book obviously is super high compared with the industry average, which is around 4. Now, you got to think right now they might be using an industry average of 4 because this has Sony and Warner and so on, because there aren't that many online streaming services other than Hulu, Apple, Amazon. So, okay, if I just skip over to Warner, which is the closest thing we can to find a comparable, you will notice the price to book is a lot lower. See, the price to book is a lot lower. That's because the inherent business model is different. So let's go back to Netflix. So the industry average here might not be super reliable, but then if you think about it, I would expect price to book ratio to be high because right now the price is insanely high. Okay, that's fine. But then previously on a balance sheet, we saw that Netflix has $7 billion worth of assets. Which if I go back here, and if I click balance sheet, then I'll see that other long-term assets is right here at $7 billion. So previously I brought up the question was if $7.6 billion should be really recorded, and the answer is maybe it shouldn't. Maybe some of it should be impaired. Maybe not all the movies and TV shows produced are actually have sufficient benefit to last however long it is supposed to last. So when you think about it, if we impair, that means write off some assets on their books, then the price to book ratio will be even higher. So that is a bad thing. So price to earnings, obviously not making money, which is bad, but then we know it's tech, so fine, we let that go. Price to book, I expect this to be closer to like 4 to 10, but then it's at 24, so it's really high again. It's probably because the price itself is at 186, so that's really high. And price to sale, I thought this would be the most accurate measure because sale is the closest thing you can use. So let's take a giant example. Apple, they do streaming services as well. Obviously, most of their money comes from non-streaming services. And then their price to sales is only 4. So that's a lot more reasonable. That's a lot more reasonable than Netflix. So right now, Netflix is at 7.6. So that's, again, bad, overvalued. And they have negative cash flow, so you can't even use price to cash flow. And obviously, they don't give dividend, which is typical tech stocks. So before I even look at insiders, if they have any, if I am management right now, I would be selling this stock like crazy. I would not buy this stock at all, and I would just, this is like the perfect time to offload because $200 is a very important psychological benchmark, which I believe the market has trouble penetrating. Second, I know everything is overvalued. Like all the ratios, price to sale, price to earnings, price to book are overvalued. If I look at a balance sheet, there's liabilities. Debt to equity ratio is 1.1. It's okay, but it's not great. Revenue has been increasing, but then the cost is increasing as well, so then the net income isn't growing, which is kind of disappointing because I was hoping the net income for Netflix would be growing. But of course it's not. So on the bright side, the debt, the $3.6 billion of debt is fixed in interest rates, but given that Netflix is a public company, it makes me wonder, why don't you just raise all equity? Because if they do that, that's actually going to drop their stock price. So having said that, let's look at the last one, insider activity. So right off the bat, let me put down my water here. CFO, sale. CFO, sale. Now these are smaller amounts, but then you see that this one, chairman of the board, president, CEO, sell at 195, 96, 97. So 195, 196, so right around here. And the timing in which he sold was November 21st, which was actually only a week or two ago, which is right around here. So this is a giant red flag. So if you think about how much money this is, so 3.8 plus 9 is around like 13.5, and I'm an accountant, by the way. So 15. So he got 15 million out of Netflix in November, which is at an all-time high. Of course, from analyzing their financial statements, I know Netflix is overvalued. So again, CFO just regularly cashing in his stocks, independent directors sell. Is there anyone even buying? So I'm going all the way back to July, and I don't see anyone buying. Okay, let's go further. Maybe there's more. Sell. Other acquisitions, they don't count. Acquisitions, it might be because they are exercising the stock, so I wouldn't really count that. And this is already back in January, eh? This is back in January. I guess you guys don't know what A is. It's a very Canadian thing to say. So back in here, back in 120. So fine, if they bought back in January, which is 120 bucks, fine, I can understand that. So after this, basically they didn't buy and it just keeps selling in this area. So then if you're asking me if you should buy Netflix today, the simple answer would be no, because A, the income statement, revenue is increasing but net income isn't, which is kind of disappointing. B, the earnings per share isn't as strong as I thought it would be, and even if Netflix continue on with its net income right now for the next 20 years, it's only going to be worth $8. It's just a ballpark figure to keep in mind. It's not 100% accurate. When you look at the balance sheet, there's a bunch of debt. They raise money, fix an interest rate, fine, but then given you're in the capital markets, I would think you can just raise money in the equity side to replace it. Given that you are a public company, I would think Netflix can just raise capital from the equity side by issuing shares, so then you don't really have the debt. But they're not. They have a debt to equity ratio of 1:1, excluding content liabilities. Third, looking at the cash flow is not great because it's negative cash flow from operations, and all the valuations, the price to book, price to earnings, price to sales are off the chart. And finally, the CEO and the CFO are selling all their shares in the market in November. So, unfortunately, it's not a buy, but obviously, I believe that Netflix has a great business model. Out of Netflix, Amazon, and Apple, I don't know who will win in the end, but those are currently the biggest 3 players in this market. And yeah, I wouldn't recommend it. So having said that, I don't feel like I need to do an analysis on the stock options because there's already a ton of debt within Netflix, and using stock option on top of that would be almost suicidal. Again, this is my personal opinion, and following my advice does not mean you would make more or less money. And make sure you do your own research.